Hey, it's Rav, and welcome to the Everyday Investor, the hottest real estate investment show in the world. That's right, I said it. I don't care who knows it. We've got a great show for you today. Before I tell you what the topic is, make sure you get your paper out, your pen, your pencil, your calculator, whatever you want, all that kind of good stuff, because we're going to learn how we can make money, how we can get a great return on our investment, investing in land development. And remember, we always ask those 4 questions to start. Whenever you're introduced with any type of investment opportunity, you want to know, what is the return on investment? Number 1, what's the return, the ROI? Number 2, when do I get that return on investment? If somebody says to you that the ROI is 20%, but it's over 4 years, then really annualized, it's only 5% per year. So it's very important that you find out, when do you get that ROI? Thirdly, what is the investment amount? How much is needed for me to invest in this particular investment? And fourth, you always want to look them right in the eye and ask, what is the risk? What is the worst case scenario? Today we're talking about land development. There's nobody else that I'd rather talk to than the guru of finance. That's right, the guru of finance. Sasha Cucuz is on the show. He is a partner at Greybrook Capital. Sasha, thank you so much for gracing us with your presence. You're so busy. You're flying around all over North America, really, all over the world in a sense. And you're a partner at Greybrook Capital. There's different kind of flavors at Greybrook, but you're known as the finance guy, right? Your background, institutional investments, a little bit of healthcare, a little tech, and yet you land in the real estate. So I want to ask you 2 questions to start. First of all, most importantly, how's the family? How's the wife, the Lily, the next one's on the way? Everything's good?
Everything's great, yeah. Can't complain about that. Everything's good on the home front.
Now, every time I talk to you, say Lily is just as beautiful as ever, but she's got the sniffles, or now she's got an infection. I guess that's just what happens with the youngins, right?
I'm learning as we go here, but it seems as though it's like a continuous sick bay at the house. So Mom and I have to maintain our health to take care of the kids, but she's sick all the time. So,
but it's a beautiful thing. And then, and I always start this show off talking about the important things, whether it's spirituality, whether it's family, because that's why we're doing this, right? That's why we're learning how to invest in development. You've taught me that 5-6 years ago. You brought me on as a bit of a, to help out with business development. I exclusively invest there. Why? So that I can have the time to be able to enjoy my family. I know you teach that first and foremost whenever you're talking to investors, whether they have millions of dollars, whether they have hundreds of thousands of dollars, tens of thousands of dollars. You always talk about the exit, the end result of why we do what we do.
Yeah, I mean, it's a means to the end. At the end, a means to an end.
Yeah.
I think that for everybody, investment is about balancing risk and reward, and at the same time, the reason that you invest your money is so that you can have a nest egg for when you retire, if you're an individual, or even if you're an institutional investor or a pension fund. All you're doing is managing money on behalf of people who are eventually going to need it for their retirement, right?
Yeah.
So ultimately, it's there to fund a lifestyle, and you have to be responsible with the way you do it.
Yeah, and the returns are not that bad, which we'll talk about.
There's worse things that could happen to you.
Exactly, throughout the show. But you're known as, with all the different types. There's 4 partners with Greybrook Capital, and you're one of them. Yeah. And then large staff and marketing and all different areas. But you're known as the finance guy. Talk a little bit about your background. As young as you look, you've been in the industry of finance for a long time. And then touch on, you've dabbled with the health and still do, the tech. But why land, predominantly in the real estate world? Yeah,
so I feel like I'm 100, although I might not look that way sometimes in finance years.
I've never known anyone to dye their hair gray on the sides. On purpose, yes. Yeah.
It's a good look.
Yes, I like it.
Really, our partners and I, we're all sort of, it's a finance company. I mean, at the end of the day, a private equity firm is just a fancy way of saying that we invest money into investments that are not publicly listed, and we predominantly use private capital, right? So we use investors' money, we use some of our own money. We do invest in 2 different sectors, one being healthcare and the other being real estate. And it's funny, they're very different. On the healthcare side, we really invest our own capital. So within this universe, it's called merchant banking. You use your own money, my partners and I, and we invest in companies on the healthcare side. It's a different risk reward. 2 seconds ago, I said that investing is all about balancing the risk and the reward that you can expect for the risk that you take.
Yeah.
In venture capital and different early stage healthcare opportunities, there's a considerable amount of reward potential, but there's also a lot of risk.
Okay.
On the real estate side,
And that's why you use predominantly your money,
That's right.
you and your partner's money, to be able to do that. And then on the real estate side, you use the everyday investor, like those that are watching at home, myself, and that obviously has less risk, which we'll talk about.
Yeah, right, and our own money. So really, on the healthcare side, you have to be trained and be able to evaluate those risks. So that's why we really use our own money. At the end of the day, on the real estate side, it was really developed as a counterbalance to a riskier portfolio. So if you look at the things that we do on the real estate side and why we're comfortable involving the everyday investors, because it's something that we feel very, very comfortable with that trade-off between risk and reward, and we think it's something, we think that ultimately over the long term, it's a great way for people to save and realize profit from their investments.
Yeah, okay, great. And you're, quickly, 15, 20 seconds before we go to break, your background, you come from?
I come from, I started in the business, I guess it'd be 15 years ago. I was an investment banker first, and then transitioned into private equity back, I guess it's 13 years ago now. So my partners and I have been together for a long time, and Greybrook's been operating in its current capacity for as long as I've been there. So
you're not just a pretty face.
Well, I'm that,
Yes.
but also have some substance behind it.
Let's talk when we come back from the break. We're talking to my good friend, Sasha Cucuz, partner, Greybrook Capital. You don't want to miss this show. We're going to learn how to make money investing in land development. Thank you for watching. We'll continue in just a moment. If you're considering to invest in real estate, always ask those 4 questions to start. Number 1, what's the return on investment? Number 2, when do I get that return along with the money that I put in? 3, what is the minimum cash amount needed? And 4, what is the risk, the worst case scenario? Hey, it's Rav. You're watching The Everyday Investor. Today is one of my favorite parts of the show where we get to talk to our mortgage specialist, Carmen Caponero from Pro Funds. Carmen, are you there?
I'm here. How are you?
Good. Carmen, how are you?
Oh, good.
Are you sitting in the beach somewhere? Are you in Florida? Are you in town? I know we actually had Jordan on the show last week, who is a VP at Pro Funds and a relative of yours. Looks like your sister, but I know it's your daughter. She was talking about how she grew up in real estate because mom would travel all over the world and be in Europe and be in the Middle East and be in South America, and you'd always just acquire property. So that's why I'm asking, where are you right now?
Well, I'm actually in Burlington at our head office.
You're in Burlington, Ontario, Canada.
Yes, I am.
Well, that's great, Carmen. So listen, what's happening with the mortgage rates? I know we invest in private mortgages, group mortgages. What's new and exciting?
Well, the rates have come down again. So this is incredible. It's a great time, as what I've been saying for the last year now. I mean, rates are incredible. So right now, we could probably secure 2.4% on a residential mortgage.
Wow.
That's a 5-year fixed.
2.4.
Yep, 2.4 came down. I think a couple of weeks ago it was at 2.59, the general rate out there. And also variable rates are around 2.2%, which is a variable rate mortgage which fluctuates with when prime fluctuates. So people want security, they can go with a fixed mortgage, and variable, they can, it's typically lower interest over the course of a period of 5 years. So
what's the maternal advice? What's the advice there? Do I go fixed or do I go a variable with a $500,000 mortgage? I
always take a variable rate mortgage. Why? Because when you take a fixed rate term, for those that are very conservative and know that they're going to be at that house for the next 20 years or 10 years, you can go with a fixed rate term. But if something happens and you need to make change, at least you're not going to be subject to any kind of large penalties when you're breaking the mortgage.
Yeah.
And on average, the variable rates have been the lowest by far over the past 10 years.
Yeah, yeah.
So I take variable rate mortgages. That's me personally, and I would recommend that.
If that's what Carmen's doing, that's what Rav is going to do.
Yeah, I think so.
Carmen, it's always great to hear your voice, and look forward to talking to you next week, and look forward to having you on the show. I mean, it's nice to have Jordan on, but I look forward to having you on in a few weeks.
I can't wait. I'm looking forward to the next one.
Okay, Carmen, thanks.
Exciting. Thank you.
Okay, bye-bye. So yeah, we're talking about land development. We're talking about the whole process and how we can make some great returns on that. But there's bank loans involved as well.
Sure.
What are your kind of thoughts there, just on the heels of Carmen? Whether it's just for yourself personally, being the finance guy, we'd love to know. What do you think? Fixed, variable, just in
question.
general. I know we're kind of going a little off topic, but just a quick answer there.
I'd say that it all comes down to the individual. I mean, I don't think anybody can understand the models on how they decide, where interest rates are going. I think it all comes down to the individual who is looking for the security and the stability of a set payment. I think even if they're paying a little bit more in interest rate, there's the peace of mind of having that set payment, and I'd go fixed. If you're the type of person that is comfortable with some fluctuation and variability in the future, you probably take advantage of the lower rate and go variable.
Why are you so wise? Those are great words, and because it
so
really,
subtle.
Because it really is a season of life. Before, man, don't matter. I'll just bungee jump and scuba dive and variable and all that kind of stuff. You get a little older, and the kids growing up, and little anxiety sets in, and all this kind of stuff. And now I'm like, man, I wish I was in the States. I want to lock in for 20 years or 25 years. So it just depends on where you are. So however you can sleep at night.
It all comes down to the individual. It's no different than when you invest, right? And we say to all of our investors, I might think that the way that we invest is the most, the best possible way in the world. Obviously, I'm a little biased, but I think it's the best possible way to invest. But everybody has different investment objectives. Everybody has different time horizons, so it's not for everybody. That's why part of our process is that our professionals will actually get in and understand your personal situations to make sure that things are suitable for you.
It's thank you for your wisdom there. Let's talk about investing in land development, partnering with the builder, if you will. And so we ask these four questions. The first question, Sasha, is obviously we're 50 plus different projects, thousands of investors coming from 30 plus countries around the world. As we exit some of these projects, 97% investor repeat rate. When people understand the type of returns, they're going to understand why people would want to continue to invest. It's not just that, and we're going to talk about why it's not just that. There's a lot of asset protection there. You're protecting my money, my capital, my investment. But what kind of returns? Walk us through, what is the ROI? What is the return on investment when we partner with the builder, generally speaking?
Sure. So the way we do things, first and foremost, we're equity. So that's an important distinction. In the type of development we do, in every development, there's an equity portion and there's a debt portion.
Okay.
We choose to be the equity because we like to have a position of control, and we like to have...
Can you explain that? So there's equity portion and there's a debt portion. Explain what those mean.
So generally speaking, in any form of development, the developer has to put up their own money to some degree, whether it's the development or their financial partner or some combination of the two. They have to put up their own money to get a project to the point of construction. And what that means is the equity is really used for land acquisition, right, to buy and own the property, and then to pay for the sales and marketing program, because in the markets that we work within, you have to actually sell the units before you can go out and build them.
Okay.
Right?
So there's money involved there, obviously. So we're buying the land, the developer, we buy the land, then we get it ready, and that costs some money, and then there's sales and marketing and so on and so forth. So this is what you're talking about. Okay.
So our money, the equity, together with the developer, we invest it together and we acquire the property, so we'll own the property, and then from that point in time we will fund what we call the pre-construction soft costs. So really it's the sales and marketing.
Okay.
And then at the point in time where you have enough sales to be profitable, you can go to the bank and get, as Carmen pointed out, a mortgage or a construction loan at that point in time, which helps you pay for the cost of building the project, right?
Yeah, so when you say enough sales to be profitable, is there a certain kind of ballpark number that we have to have enough of, and those people, the end user, they're putting deposits down?
Right.
And okay.
Absolutely. So what happens is we, together with the developer, buy a property, we put up a sales center, and we sell it to, as you point out, a certain threshold. That threshold is going to be a little bit different depending on whether it's a low rise or a housing development versus a high rise.
Okay.
But in every context, that threshold is usually anywhere between 50 and 70% of the total units. It's really, the banks use that number as a proxy that once you've sold, let's say 70% of the units in a high rise,
Yeah.
you've secured enough revenue from delivering those units that if you didn't sell one single other unit, you'd have enough money to break even. So it's the break even point.
And that's what I love. I'm in 9 different projects. Thank you for introducing them to me, and they're very exciting. That's what I loved about it the most was we have the land that we purchased with the developer, and then what happens is once we sold out 70% or so, then and only then do we break ground. So it's not like most of the world where I have to where my brethren are, and whether it's Middle East or Vegas or wherever it is, where we build and then we hope to sell.
Sure.
And so, because this whole process only really takes what, 12 to 18 months kind of thing before we put a shovel in the ground typically, or?
Usually, yeah, it's about 12 to 18 months. So it's not like that everywhere in the world. If you're from the GTA or from Ontario, broadly speaking, sometimes you take for granted that when you buy a new condominium or a new home, you walk into a sales center and you buy it off a plan.
Yeah.
And then 2 or 3 years later, when it's built, you move in.
Yeah.
In most parts of the world, the developer actually builds it, incurs all the cost, and then hopefully sells it and hopes the market's stable.
Yeah.
So what we love about the way that development is done in the markets that we participate in is the very fact that we see ourselves as landowners.
Okay.
Right? We buy the land, and if the markets are good and the market exists, that's something nobody can control. If the market is good, then we will be able to develop and sell and realize our profit. And we're not taking the risk of that construction loan until we've already sold enough to be able to pay it all back.
Yeah.
But if for some reason that's unpredictable or something that happens outside, the world stops for a period of time, like it did in the U.S. in 2008 and 2009, you're not going to be able to build anything because there's no buyers. But at the same time, you haven't incurred the loan, and you're just sitting on the piece of dirt that you own.
Yeah.
And our fundamental thesis is that if I buy a good piece of land, I buy it at a good price, and I buy it in an area where people already want to live, then at some point in time, they're going to want to live there again.
Yeah.
The market may be there, it may go away for a period of time, but that land will always have value, and at least we'll own it and hold it until the time is right to be able to develop it.
So let's talk about what the projected returns are, and kind of maybe compare it to just a typical, if Rav, what I used to do were to buy an investment property.
Sure.
So if I were to buy an investment property compared to what the projected returns are in land development.
Sure. So what we always say internally, our goal is to double our money every 4 or 5 years.
Okay.
Right. So that's kind of our internal objective.
Double our money every 4 to 5 years.
Right. So you put up $1. Within 4 or 5 years, we hope to give you your dollar back plus another $1.
Yeah.
That's really the objective.
20, 25% kind of thing.
Right.
Annualized. Yeah.
And when a lot of people look at that, especially in the investment world, without understanding the structure and what it is that we're doing, they look at it and they say, wow, that's a big return. I mean, my mutual funds don't do that, and my other investments don't do that.
Yes.
And I don't draw an analogy to a mutual fund. I draw an analogy to something people really understand in real estate, which is their own home. Right?
Yeah.
So if I buy a house, and let's say, I'm in Toronto and I paid $1 million for a house.
Yep.
And I put my $200,000 down, and then I went to Carmen and I got a mortgage for 80% of that at 2.7% or 2.4%.
Yeah.
I may be seeing Carmen about that.
Yes.
But I will use a mortgage for $800,000, and then call it 4 years later when that house is worth $1.2 million, which is not an unreasonable rate of return on a house, right? It's about 5 or 6% a year, which is in Toronto quite low actually. But that house is worth $1.2 million. You sell it, you pay off that $800,000 mortgage, and now you're left with $400,000. Well, you started with $200,000.
So I doubled my.
You've doubled your money in 4 years.
4 to 5 years.
Right.
Okay.
And what allowed you to do that was the leverage, right? The mortgage. Now, in the type of game that we play, we also use leverage, but you're not taking the risk of the leverage until you've already secured the revenue. And that's one of the things that we are comfortable with, and that's why we invest so heavily in this area, because we really like the risk protections that the underwriting environment gives us.
And those deposits that the end user or whoever's purchasing the units or the housing, they're not a few bucks like they used to be in the 80s where you could put down $500. We're looking at 15, 20, 25% deposits.
That's right.
So if somebody wants to buy a $500,000 home, they're putting down $100,000
That's right.
to be able to do that. And so that makes me feel comfortable as an investor. I'm thankful that our banks are, I don't want to use the word, I was going to say stingy, you say conservative, that's why you're smarter than me. But I'm grateful that they are, because this now I feel very secure. I can sleep at night.
Yeah, I mean, at the end of the day, the banks aren't in the business of taking undue risk. And they look at the world and say, if I've got somebody who's buying a unit or a home and they put $100,000 down, as you say, on a $500,000 property, that's a significant investment. So if something happened to alter the world 4 years from now when you take possession of that home, the fact that you have $100,000 of your own money invested means that even if the world changed significantly, you're very unlikely to just walk away from your deposit.
Yeah.
Even though you're contractually obligated, there's all kinds of things. But at the same time, there's one thing to be contractual, then there's another thing to have your actual dollars invested.
Okay, well, let's take a quick break. We learned that the ROI, we can be looking at projected returns of 20, 25%. You said double your money every 4 to 5 years. When do we get it? Depending on what we're building, and we'll talk about that when we come back from the break. We're talking to my good friend Sasha Cucuz, partner at Greybrook Capital. We're going to put some numbers on the paper for you. Don't go anywhere. The Everyday Investor continues in a moment. Did you know approximately 100,000 people come into the GTA every year? That means 36,000 homes must be built every year to accommodate the growing population. Hey, it's Rav. Welcome back to the Everyday Investor. Today we're learning how to make money partnering with the builder. We're learning how to make money investing in land development. We have my good friend, partner at Greybrook Capital here with us, Sasha Cucuz. Sasha, it's great to have you on the show. We've talked about, this show's been running for a while. It's all over, Ontario, and we want the viewers at home, just everyday people like you and I to understand that there's a lot of money to be made in real estate, and there's different kind of vehicles, and the questions that we want to ask always is, what's the return on investment? And you've done a great job, answering that. You take a very conservative approach, because I know some of the past exits, and they've been a lot more than the 20-25% annualized type returns. But that's what I love about Greybrook. We want to always under-promise, over-deliver, as we really take care of people's money. I think the fancy terminology for that is, you guys are asset managers, which we'll talk a little bit more. Before we do that, I want to talk about, the types of projects that we're building. I think you brought a few slides of some kind of active projects right now, so maybe we can bring those up and you can address those.
Yeah, I did. We focus on Southern Ontario predominantly and South Florida. Here's a project called Garrison Point. So that's in the Liberty Village area of Toronto. So it's a very bustling place in the city near the CNE. That's a project that we're doing together with Citizen and Fernbrook.
Yep.
And we're in construction on that project right now. So it's going extremely well.
Okay.
That's one of them.
Yeah.
140 Yorkville Avenue. So this is a part of the city.
140 Yorkville Avenue.
Yeah. So
the Yorkville.
The Yorkville, yeah.
Yes.
So for people that are not from Toronto, or viewers from other parts of Ontario, Yorkville is kind of the fancy schmancy version of Toronto, like Park Avenue in New York. So
yes.
We own a property there that is right in the heart of Yorkville, and we'll be developing that together with Empire Communities. So we're about to launch sales of that in the upcoming fall-winter season. So that's a project that we can look out for.
Yeah. And I think we brought another one.
Skylofts, yeah. So this is a project that we've done together with Stafford Homes.
Yeah.
This is what we call a stacked townhouse. So this is something that is a different product type. It's not a high-rise, but I always say that, you have to deliver all types of housing. That stat that you showed earlier of the 36,000 homes, it's not just high-rise. You have to deliver townhouses, single-family houses, and condominium units, because consumers have different requirements and different preferences. So this project together that we are doing with Stafford is in the Malvern area, which is kind of part of Scarborough.
Yeah.
And that's a project that we're excited about as well. And we're sold out, and now we're in construction there.
Yeah. No, I mean, and these, this is not, we're not building with Cousin Vinny here. These are the biggest players in the industry. You're talking Yorkville, and these are just three that you brought. There's many more that are active. We're on the water, we're in Lakeshore, we're in Markham, we're so many different places. These parcels of land, what's the purchase price for these prices, and how do you acquire those as well? I know you have none of these are on the MLS. None of these are purchased above market value. Mm-hmm. That's again what I love being an investor, is that if we were just even, and I know you're going to kind of draw it out here on the whiteboard here in just a second, but if we were just to purchase do some things to it, plant a few roses, and then sell it, I, as the investor, would still make some money.
Yeah.
Right. So talk a little bit about who our partners are, and just how privileged we are to be able to work with them.
Sure. At Greybrook, one of our taglines is exceptional partners, exceptional returns, and you can't have one without the other. So it's impossible to have exceptional returns without the partners we have. So as you mentioned, we work with some of the largest residential developers in Ontario and the U.S. And really, at the end of the day, it's a partnership approach to business. So they are in the business, these guys, and they built organizations for decades to find the best properties and develop them and get them to the point where they're ready for an actual development. So we rely on our partners more often than not to bring us the projects that they think are most viable, and we in turn are a partner for them on the financial side, and we are a reliable source of equity and partnership for them. So our strategy really internally is to plug ourselves into the biggest and best and make sure that we can basically get in bed with them and produce a great return for people.
And we've never lost an investor dollar. We've never lost an investor dollar to date. In fact, I think the lowest annualized returns are in the low 20% range on an annualized basis. So I mean, obviously we're doing a good thing. I understand now why there's a 97% repeat investor rate. I understand why we're not just doing one deal with these developers. You have such a great relationship, Greybrook, and the developer, that you do multiple The one thing that I do want to ask you though, you talk about the GTA, Toronto, the Greater Toronto Area, a little bit of South Florida. Isn't time up? I know that we've, isn't it oversaturated? Don't we have enough? Everywhere I go, I see a crane in the sky. You've already kind of answered that question though. When I see a crane, they're building product that's already been sold, so I kind of get that. But still, why here? Is it not over?
Well, that's a good question. I mean, I don't think it is. At the end of the day, Toronto has some very strong attributes. It's a growing city. We're still an infant relative to most global cities that are of any size or consequence. So Toronto, by comparison to most other places in the world that are considered to be sort of cosmopolitan centers, is still very affordable, and we're still in a very early stage. So as our city continues to grow, if you look at the population trends and you look at people that move into the city, and there's some 6 or so million people in the GTA, there's an actual need for housing. This isn't a speculative market. It's one where there's an actual fundamental need for people to have a place to live.
And Mama always taught me that when you have more demand than supply, then we need it. And we read at the break before going on the break, and maybe we can just pull up. You brought it.
I brought another chart
as well. But there's 100,000 people moving in just into the GTA alone. Here it is right here. I mean, this is uncanny when we look at other first world cities around the world. I mean, explain it to us. What does that mean, PSF? And kind of explain this.
So this, in our world as sort of development partners, we think of everything on a per square foot basis. So that's what PSF stands for. Because at the end of the day, a consumer thinks, I'm buying something that costs $300,000 or $500,000. To us, the developer, we make a margin on every single square foot, right? So whether you're buying a 500 square foot unit or a 1,000 square foot unit, we're making a margin on a per square foot basis. So what you're seeing here on this chart, the 2 black circles are the 2 markets that we develop in. And this is really meant to be a sort of a global comparison on price point. And you can see that Toronto, on average, across the city, is still significantly cheaper than most global centers, as is Miami, which is another center that we develop in. So really, this is just an illustrative to show that there is relative value between Toronto and other places.
Yeah, no, that's amazing. I mean, so when we look at that, London, Singapore, Hong Kong, I mean, these places are astronomical. I mean, it seems like Toronto's on sale, and I just never would have thought that, because I mean, it's one of the best places in all of the world to live. I'm here in Canada, so. 100,000 people moving in, 30-some thousand dwellings. We're not just building condominiums. I mean, there's many things. There's different classes. Talk a little bit about that, and then even time horizons in terms of how long something would take to build. I mean, I think recently you guys we just closed on a deal in just West Toronto there even.
Yeah.
And that's a whole. You're building a whole new
community.
You might as well have its own, change the city name to it,
It kind of does. We're coining it the Lower Junction Triangle, so it's something that is a community in and of itself. So very similarly, Liberty Village, we did some 2,000 units in Liberty Village between 2007 and today, or 2006 and today. And when we got started there, it was really just tumbleweeds and railroad tracks. So part of development and part of why you realize such a return is you're going into areas that on a relative basis are either undervalued or not yet developed, right? And you're going in and actually doing the development, and you unlock value in doing so. So in the Lower Junction Triangle, you mentioned the fact that we do other things other than just residential. So we have a project there together with our partner Castle Point. And with Castle Point, we are building on 8 acres in the Lower Junction a mixed-use community that's going to deliver some 600 residential units in the form of either townhomes or condominium units.
Oh, is that there? That's it right there that you just pulled up?
This is kind of the eight acres. What you're looking at there on the screen is something called the Tower Automotive Building. So that is an office building that will be part of this development. So it is a mixed-use development. It'll have residential as well as commercial and retail. And the focal point is this Tower Automotive Building, which in 1919, when it was built, was the tallest office building in Toronto. So you can see it's been surpassed quite significantly by today's Toronto. But we're going to be retrofitting this building. We have the fortunate circumstance of working with MoCA, the Museum of Contemporary Art in Toronto, where they're our primary tenant, and they'll be inhabiting half of this development. So we're really excited about that partnership.
Yeah, that's very cool. Very nice. And so, this is not, so let's talk a little bit about timelines there. So when we're doing because there's going to be a high rise there, there's low rise with townhomes. I think there might be there's some commercial and retail and all.
There is, yeah.
So how, is everything 4 to 5 years? Are there things that are, 1 year, 2 year?
That's a great question. Every investor wants to know, okay, so I get a return, but when do I get a return? So typically when you're doing a tip 1 high rise, it's about a 4.5 to 5 year time horizon, beginning to end, from the day you make your investment to the day we realize our profit.
High rise meaning condominiums?
A condominium. Anything I say high rise is anything that's vertical, right? So not a home. In these mixed use communities, it is a little bit different. So we phase them. So the project in total might be 6 or 7 years, but what we try and do is complete certain portions of the development in advance of others. So for example, in that Lower Junction project, we've already sold all the townhomes and we're going into construction. And we're about to launch sales actually earlier next month, at the beginning of next month, with our first condominium there. So by the time we're finished those would be kind of phase 1 along with that Tower Automotive Building. We'll probably unlock most of our investment. So investors will get all of their money back plus some of their profit, and the rest of that program will be all upside.
Because the townhomes obviously are quicker to build than the high rise. So in this particular case, those townhomes will be completed, and the end users will move in within 24 months,
2 years,
2 years or so. And so me as an investor, now I'm going to receive monies on my investment after the townhouse is done. Then now we're into the condo, and it's already been happening. So then the next year I make more money, and there's maybe some commercial, and I make more. So some of these are kind of act like cash flow in a way, where there's different kind of outcomes.
The phased developments, what we really try to focus on is we try and be responsible and get people their money out, and our money. We invest in every project that we do. So we try to get our capital out collectively as soon as we can, and then with the rest being upside, right? So in that Lower Junction project, it's a very large project with 8 acres, but we'll be through in the first kind of 24 to 36 months a bulk of that first phase, which will unlock our initial capital that we put in. And once we have that in our genes with some of our profit, we can just watch the upside from there.
It's great, and it's great that I don't want the viewers at home to miss what you just said there. That you, as well as the other partners, you invest in every single project like Rav would on the same terms and conditions.
That's right.
I think that's exciting. So we have a bit of a couple slogans at Greybrook: exceptional partners, exceptional returns. But your mandate is kind of threefold. We want to acquire, execute, and exit.
That's right.
I think we've got to go to a break here. We have this lovely
I'm dying to use the flip chart.
Yeah, so when we come back from the break, we'll do that. But just quickly, 20, 30 seconds, talk to us a little bit about acquire. We do something to it, and then we get out.
That's right.
So
every single thing we do has a development plan attached to it, and we, Greybrook, aren't just there to put the financing together, give it to the developer, and move on. We're a long-term partner, so we stay together with the developer, lockstep throughout the whole development, representing our money and your money. And ultimately, our goal is to buy the property and own it,
execute
do something to it, as you say. That's the execution piece, and we monitor that,
Yeah.
and then ultimately exit, and that's how we realize our profit.
Okay, great. Well, we answered the first question already. What's the return on investment? Secondly, when do we get it? Well, it depends on what we're building, frankly, and some can have different kind of stages. When we come back from the break, I want you to write on this, as well as we'll talk about, what are minimum investments? How do we kind of get into that? You're watching The Everyday Investor. We're talking to my good friend Sasha Cucuz. We are just halfway down the show, or maybe 2/3. You don't want to go anywhere. We'll be right back. Thanks for watching, everyone. Did you know in 2015 the price gap between condominium apartments and fully detached homes in the GTA was 53%? Hey, it's Rav. You're watching The Everyday Investor. We're back with my good friend Sasha Cucuz. He is a partner at Greybrook Capital, and our topic today is how do we make money in land development? Sasha, it's great to have you on the show, and I always learn. I've been with Greybrook for 5 years now, an active investor, but I always learn. You're a busy man, and so just to have a conversation with you, I say come on the show.
I got to bring you home with me.
Yes,
because this is great. I got to introduce you to my wife, and you can come home with me. Well, you know her, but
so we were talking about really what Greybrook Capital does in the whole land development world. We acquire the land, we do something to it, we execute on it, and then we exit. But Rav's the investor. And so Greybrook is the one that kind of is, protecting me. There's an asset protection here all the way through. It's not just like, we acquire the land and then we let the developer do any execution and kind of exit and we hope for the best. We touched a bit on it, but kind of walk through the whole, how does it kind of work, kind of from beginning to end, the whole land development piece?
Yeah, so I think it is important to distinguish the fact that we are asset managers, as we call it in our business. We stay on with the developer and we actually co-manage the development.
Yeah.
They're responsible for all the day-to-day work. That's why, we talk about exceptional partners, exceptional returns. Well, they're exceptional partners at what they do, which is development. So the construction, the sales, all of that stuff, they are responsible for. What we're there to do is to make sure that we monitor and manage that development plan. So when we agree to things that we're going to do and budgets and things like that, we stay there and make sure that they're actually executing the strategy that we've set out. And if there's any change or anything unforeseen happens in the market and we have to pivot, well, they can't just make a decision on their own and do whatever they want to do. They have to come to us and we have to approve it. So it's a real mechanism where the investors have a voice at the table, people that have been around the development business and understand how to manage risk. Because it's great to talk about returns and it's great to talk about generating 20% or doubling your money or all that kind of thing. Our philosophy, the core to our philosophy, is risk management. Because at the end of the day, the returns will be there if the world is whole. But nobody has a crystal ball. Nobody predicts when the next recession will happen or whether I'm right about Toronto or wrong about Toronto. Really, it comes down to how do we position ourselves most defensively. So I frankly will tell you that most investors are the happiest when we can mitigate their risk rather than striving to hit.
So let's talk about that. That's the fourth one, right? We didn't hit the third one. Who's eligible to be able to invest? Since we're talking on that, what is the risk there? So if we answer the first question, what's the return on investment? You shared kind of conservative 20% plus, and this is on an annualized basis because obviously we have to complete the project.
That's right.
Before we, so if it's, a 4-year project or 4 or 5 years, we basically double our money, right?
Yeah, we're not going to get involved in a project unless we project that we can make at least this, right?
Yes. So
low margin deals or deals that just aren't there, we'll pass on them.
Yeah.
They have to fit a specific criteria.
And how many deals would we look at, in a year? How many come across your desk? Isn't it an insane number, like 150 to 200 different projects that you look at, but you only take ones that will?
Yeah, I think so. And it's not just the returns. We have to look at the property and how it's zoned. We don't take certain risks. We won't buy something that's zoned for some other use and try to convert it because that's a legal or a municipal process.
Yeah.
So our whole point is we try to mitigate all the risks. So all the things that you can control, right? How you buy a property, what you pay for it, the return thresholds that you're looking for. Those are all risks that you can manage, right? And then you have to rely on your structure, right? That joint venture structure and the control that we have together with the developer to be able to mitigate the risks that you can't foresee, right? And that's the whole game of asset management. It's what you're trying to do is manage risk against the reward that you expect.
So what would be some of the, so when do we get this? Well, it depends. If it's a condo, it can be, 4 years or so. If it's housing townhomes, it can be as, little as 2 years. I mean, depending on what it is. But the point is, it's going to be, well, history says it's 20% plus annualized, whether it's 2 years, whether it's 4 years, that kind of thing. So what I want to talk about now, since we're on it, is what is some of the risk involved in this play? And again, it's all about mitigating, right? And so
Yeah.
so share. You always say, Rav, you can only think of two things generally, but I think it's good.
I think ultimately it boils down to two things.
Yeah.
I think it's important to say, it's the way that you do development. So the best analogy I can draw is you and I can be crossing the street. I can cross the street when the crosswalk is green with the little man flashing, and I can cross the street perfectly. You can try to do it on your hands, blindfolded, in the middle of rush hour traffic.
Yes.
At the end of the day, we're both crossing the street, but you're doing it in a much riskier fashion than I am, right? So development's no different. You can do development and not, at the end of the day, me and another developer might be doing the exact same thing, which is building a condominium, but there are certain risks that you can take along the way if you're willing, and there's certain risks that you can mitigate if you're not willing. So a good example is that entitlement risk. Some developers will buy something that's zoned for another purpose and try to rezone it to be able to get what they want.
That's called entitlement risk.
Entitlement risk. We don't take entitlement risk. So another example would be using an excessive amount of leverage, right? So buying a property and actually putting a big mortgage on it and then relying on the fact that the market's not going to go away and everything will be fine. We like to manage our leverage and either use no leverage, which is the case in about 80% of the things we buy, or what we call responsible leverage, which is a very small amount of leverage that makes the project make sense, but doesn't put us in a position of risk.
So we acquire the land, but it's pretty much ready to build. It's pretty much ready for execution in a sense, as opposed to buying grandma's farmland and we hope 5-10 years, and that's entitlement risk. So we don't do that. And then secondly, the second thing that you said there was
just the leverage. So you can buy a piece of property.
We buy it debt free, or there's something on it that's generating some income, perhaps.
Correct.
Just in case of a rainy day.
That's exactly right.
Okay.
So that's kind of how we do things. So that's really what we look for. So the return profile that you put up here is yes, that's our targeted return profile, and depends on what we're building.
Yeah.
These will be the time horizons. But as we talk about acquire, execute, exit, our role in the whole equation is after we bought that property and own it together with the developer.
Yeah.
That's when the work begins, right? Structuring the deal, underwriting the deal, raising the capital, that's not where the work begins. The work begins on day one, where now all of a sudden we own this property.
Yeah.
And the developer has to put their hard hat on every day and do exactly what they're going to do, and we are there meeting with them on a regular basis, lockstep, to make sure that that plan is executing. And frankly, if there's a curveball thrown at you, you got to be able to know what to do with it.
I've been investing since I'm 16 years old, right? I'm 44 now, almost, what is that, 28 years? And a lot of my colleagues in the real estate world, the broker world, the tangible, kind of real estate, we kind of just buy it on the day and, we try to tenant it out or flip it or so on and so forth. What I love about this is just the different phases in it. You acquire the land, and then there's just this huge, from the time we acquire to the time we build and so on and so forth, there's this big curve where we make money. Are you going to draw something?
I can actually draw something.
Okay.
I was so excited, and now I get to do it.
Yes.
So if you look at sort of a very simple graph, right? So here, this axis here we'll call the value axis.
Yeah.
Okay, that's price.
Yeah.
And then here we'll call the time axis.
Okay.
Okay.
Yeah.
With land, and then there's three phases as we think about the world, right?
Yeah.
There's something called entitlement,
Yeah.
which is what we just talked about, and I'll explain it again.
Yeah.
Then there's land development.
Yeah.
And then there's manufacturing. Okay.
Okay.
So in a development, when I buy a piece of property, if I buy a piece of property here,
Yeah.
what I'm doing is I am trying to buy something that is a farm, for example, grandma's farm, and get the laws to change so that I can build houses on it, right?
Yeah.
That requires municipal process. You have to actually zone the property and do all these things. So here there's a risk.
Yeah, because we don't know how long that could take.
It's not just a matter of time. The bylaws may never change.
That's right.
The city may never designate.
Yeah.
In fact, in areas like Toronto where the green belt is expanding,
Yeah.
development areas are actually becoming non-developable because the green belt keeps expanding. So,
Okay, so
we don't play here.
We don't want to buy here. here
Yeah.
because there's a possibility it'll never happen.
Correct.
Okay.
So on the value side, if a developer, let's say, were to buy here,
Yeah.
okay, that's where the value is the lowest because it's a farm,
Yeah.
right? And take it all the way through the process. And now here, this is called the land development phase. So this is where you have a bylaw, so you can actually develop those homes.
Yeah.
But now you got to work with the city on design and layout and where the parks go and where the cities go, or in a high rise, where the garbage lanes are, and you have to agree with design and shadow studies and all these things. That's called land development.
Yeah.
And then here is when you're actually ready to go, ready to sell.
We have all our deposits. We're all set.
That's right.
The bank gives us the manufacturing loan, the construction loan.
And now you're
then
now you're making your money on the margin, right? The manufacturing margin between wholesale, what it costs me to build it,
Yeah.
and retail, what the consumer buys that
So
for.
keep going on. I'm very excited
Right.
about this line here.
So the developer here that bought here
yeah.
is making money as time goes on because this process all takes time.
Yeah.
Value is increasing, right?
course.
So here they make money just, as you said, by planting some roses. Okay, it's not that simple. They're doing some legal work and some process work.
Yeah.
And then they pick up a manufacturing margin on top of that, okay? And then here's your exit.
Wow.
Now-
so because I know, like I said, 28 years, I know one thing, that when you change the use of something, that's where you make the biggest bang for your buck.
That's right, but that's also the biggest risk. So why we don't play here
Yes.
is while you can make a lot of money on this bump
Yes.
between entitlement and now I got to develop it.
Yes.
It's also,
we don't know if it's
it may
gonna
never happen,
Yes,
right?
yes.
So we choose to get involved here.
Yeah.
Right?
No, but that's what I mean. You're still changing the use because
Correct.
now maybe we're allowed to, but here you're changing the use. So I'm saying from here to here even, I make a lot of money. So let me ask you this question. From here to here, I make a lot of money
That's
if
right.
I were to sell. Are we playing in this field? Could we sell here?
We could. So we always talk about acquire, execute, exit. Well, the exit piece, we always set out with a plan, right? That plan might be to develop homes, for example.
Yeah.
But as we go through this process, as an active asset manager, our job is to balance risk and return. So if all of a sudden we've spent 2 years getting the site plan approval, as they call it, now we're ready to go, ready to open our sales center. And by the way, now land prices are astronomical because everybody's clamoring to develop in the area.
Yeah.
We may sell it right here.
Yeah.
Or if we think there's enough margin to be had and markets are very strong, we may continue with development. So our job is to be able to assess along this curve where we get out, how we get out. Although when we start the process, we always have a very defined plan.
Yeah.
And that's an important thing because if all else stayed the same in the world, we're going to go beginning to end according to our plan. But that's not to say that we're not going to be opportunistic along the way if it presents itself.
And again, that's why this is not a fund. Here's a project. It's specific. I get to see the timelines. I get to see the returns, the projected returns, all that kind of stuff. If we can make more by doing something like selling at this point, then why wouldn't we? It all depends. And I think that's where Greybrook is at the helm of the investors, and their capital, to be able to walk through the whole thing. We acquire it, we execute, we exit, everyone's happy, and we do it again.
The one thing I want to add to that, and this is important,
Yeah.
our developer partners, we focus on making money the same way. The investor makes money, Greybrook makes money, the developer makes money, all the same way from the profit, right? So by aligning those interests, we make sure that if this is good, as you say, if this is the right thing for the investor, it's going to be the right thing for the developer. It's going to be the right thing for Greybrook. So when we make these decisions, everybody's on board because we've aligned our economic interests.
Yeah. No. I think it's great. When we come back from the break, I can't believe an hour's already gone by.
I got to use the chart.
You got to use a chart. Time flies when you're having fun and being educated, as I am. We got to talk about who can invest. So when we come back, we'll just quickly talk about who can invest and kind of your closing thoughts.
Of course.
You're watching The Everyday Investor. Don't go anywhere. We want to hear from Sasha's who can invest and how, and just his closing thoughts. Thanks for watching, everyone. If you have any questions pertaining to this show or there's a topic that you would like covered, please visit www.rogerstv.com. Hey, it's Rav. You're watching The Everyday Investor. We've had a phenomenal show talking about how we can make money investing in real estate development. If you've missed any of it, make sure you see the repeats. If you want more information about Greybrook, please go to www.greybrook.com/realty. And also there's a blog there. So if you want to keep up to date in terms of all the things that are happening with Greybrook, projects, how you can get involved, all that kind of stuff, then make sure you visit that site. Sasha, really quickly, I want you to touch on who can get involved in these types of investments. And then secondly, just kind of your closing thoughts until we have you back again, which I hope to do soon.
Sure. So in terms of involvement, we're security by law. So up until this year, our products were available only to accredited investors by definition, and there's a technical definition for that. Today, it's a more broad group that's available, a group called eligible investors, so the thresholds are different. All of this is extremely complicated.
Yeah.
So the point is that we have trained professionals that work within Greybrook, and if you're interested in this and it's something that you want to get involved in, all you have to do is get a hold of us through our website, phone, email.
Okay.
Just get a hold of one of us, and we have somebody that'll call you, talk to you, ask you some questions, and help distinguish A, eligibility, whether you can invest based on your personal situation,
Yeah.
and B, and this is an important thing, suitability. Because just because somebody thinks it's a great investment, everybody has different risk tolerances, investment objectives, time horizons, and we have to assess that and make sure that even though we think it's the best investment in the world, it has to be right for Rav.
Okay. And then what's the last thing as you go, 15, 20 seconds or less, what would you say to the viewers at home?
I think that when investors are looking at any type of investment, you have to really look at two things. I think you have to look at the opportunity itself, and then I think you also have to look at the people behind it. I think it's very important to understand who your partners are. We built our business on exceptional partners. We do a lot of due diligence on the partners that we have, and I would encourage investors to do the same.
Okay, great. You can visit greybrook.com/realty if you want some more information. On behalf of Rogers TV and myself, Rav Toor, we'll see you next week, same place, same time. Honey, I love you. I'll be home soon. If you want some personal information, visit me at www.ravtoor.com. Thanks for watching, everyone.